There's no such thing as a national housing market. There are only local markets. All real estate is local, as the old saying goes. Just understand that there are nearly 400 what they call MSAs, or metropolitan statistical areas. There are over 3,100 counties, and there are over 9,000 cities. And according to ex-President Barack Obama, there are 56 states. Just thought I'd throw that one in.
And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Ladies and gentlemen, meet Jason Hartman, and by the time he gets through, you're going to understand why we got him on here, because we get what he's going to talk to you about. We get questions about all the time, so let the expert answer them for you. So I'm going to turn it over to you, sir.
All right. Well, thank you, Ron. It's great to be here, and I am doing something here in Palm Beach, Florida, that I never get to do, and that is wear a sweater. I know all of you are all over the country and even all over the world following Ron's work, but we suddenly got a cold front, and it is a frosty 68 degrees here in Florida, or here in Palm Beach, Florida. So kind of feels nice to actually wear some clothing for a change. Anyway, great to be with everybody today. The market is changing. There is no question about that. And I think you all know that already. And I'm here to talk to you about that. As any of you that have followed Ron's work and have seen me speak at prior events that Ron has hosted and his team has hosted, you know that I created an index called the Hartman Comparison Index, or the HCI, the Hartman Comparison Index, to help evaluate the price of real estate. It is absolutely amazing to me how many people, they really have a lot of blind spots because they're following the traditional real estate indices like the Case-Shiller Index, which only profiles, well, 75% of it profiles a certain type of market. And then there are many other indexes as well. And, we're all trying to figure out, where are real estate prices going next? Are they going up, down, sideways? What's happening? So that's one thing. There are three types of markets in the country or in the entire world. And we're going to take a look at those for a moment. We're going to take a look at whether or not homeowners are distressed. My thesis, after being in this business for many decades now, is that if you want to have a real estate crash, you've got to have distressed homeowners that turn into distressed sellers. I'm going to show you some data on that, which I hope will be very helpful to you, very enlightening to you today. I also want to encourage you, when you take a look at my comparisons in the Hartman Comparison Index, that you understand that everybody, when they're looking at real estate valuation, they're only comparing the value of real estate to one thing. What is that one thing? It's the US dollar. Why would they do that? Because we all know, especially with inflation running rampant right now, thanks to Bidenomics, okay, and Jerome Powell denying inflation when it was occurring and saying it was transitory, and all of this gobbledygook we hear from our government and our Federal Reserve Bank, we are in a serious inflationary spiral right now. And we know that our dollars are depreciating in value constantly. So the dollar is a moving target. Why would we only try to value real estate based on one thing, one comparison, the US dollar, when we can compare it to lots of things that have intrinsic value, that are traded globally, that are needed by every human being on earth, and they are just a better comparison than the dollar? So we're going to get into that. A big part of our talk today is about understanding, when you're trying to value the market and figure out where it's going, what is your measuring stick? What are you measuring it against? Just the US dollar or a whole basket of other things? So let's go ahead and dive into this. Three basic types of markets in the country: linear markets, cyclical markets, and hybrid markets. Linear markets don't get much attention, but they are the best markets in which to invest, and they deserve a lot more attention because they're slow, steady, profitable, and they have great cash flow. Cyclical markets, on the other hand, get the most attention, yet those are the riskiest markets to invest in. They look like a roller coaster when you're looking at a chart. Hybrid markets, as the name would imply, is in between the two. Here is an example. So Memphis, Tennessee, this is a market we've helped hundreds of investors buy properties in, and this is a linear market. If you're looking at an appreciation chart, since the early 1980s, you can see that it's pretty slow and steady. It's got some ups and downs, but they're not very pronounced. Indianapolis, I should say, is another market that we've helped hundreds of people buy properties in over the years. Again, a boring linear market. Now, let's compare that to where I grew up in the Socialist Republic of California, specifically Los Angeles, California. And when you look at this chart, you can see it is a roller coaster. It's got glorious highs, it's got ugly lows, it's up, down, it's up, down. It's crazy, very, very hard to predict. This is a cyclical market. So these two, very different. Now, what are some examples of other cyclical and linear markets in the country and around the world? Well, cyclical markets are basically the trophy markets. They're the West Coast of the United States. They're the expensive Northeastern markets, New York, Washington, D.C., Boston, Massachusetts, right? Those types of markets. They're where I live in South Florida. Those are cyclical markets. Around the world, there are places like London, Dubai, Paris, Hong Kong, right? Those are also cyclical markets. But the vast majority of the world is linear, right? The most of the world, most of the country is a linear market. So it's just funny how we really don't kind of evaluate this properly when looking at different markets. Remember, in a country as large and diverse as the United States, there's no such thing as a national housing market. There are only local markets. All real estate is local, as the old saying goes. Just understand that there are nearly 400 what they call MSAs, or metropolitan statistical areas. There are over 3,100 counties, and there are over 9,000 cities. And according to ex-President Barack Obama, there are 56 states. Just thought I'd throw that one in. Okay, so the index really answers the question, compared to what? And I call this life's most important question. I say it so often, or ask it so often, that my listeners even dubbed it the Jason Hartman question. Now, clearly I did not invent the question, okay? But it is a really good question for anything you're doing. If you're trying to value real estate or anything else, we do this by comparison. We are comparison creatures. Now, you might be thinking, well, obviously, when we're trying to value a house in a neighborhood, we look at the comps, right? We look at the comparable sales. It's a lot more than that. But yes, that's absolutely true. Okay, so compared to what? And the underlying premise to that question is it cheap or is it expensive? And that's what we need to understand in order to understand where the market is going. So the most common question we get asked is, are we in a bubble, right? And if we are, when will the bubble burst? Here's a couple tidbits of information for you. So between January of 2012 and June of 2021, 12.3 million new households were formed, but only 7 million homes were built. Now, that would imply that there's a housing shortage. And a lot of you have already heard how the National Association of Realtors and many other sources are saying we're over 5 million homes short, right? But what I want to say about this is it's actually worse than this in terms of the shortage. Because what this doesn't tell you, and I always try to ask whenever I'm looking at anything or hearing anything, I always try to ask, what are they not telling us? What are they not saying? Another thing I talk about constantly on my podcast and YouTube channel is this concept. And it's a really important concept in life besides the compared to what question. And it is this: you can't hear the dogs that don't bark, right? There's a profound impact to what doesn't happen, or what you don't hear, or what you don't see, right? There's a lot of things that just don't happen that tell us a lot. And, I'll just give you an example from a common political debate, for example. Minimum wage, right? We're in a situation, unfortunately, today where the wealth gap is growing like crazy. The rich are getting richer. The middle class is being pushed down into the poor class or the lower middle. And it's a tough time for a lot of people. But the response to that is like, well, let's just raise the minimum wage, right? And that'll solve all the problems. And while I feel terrible for minimum wage workers, and I used to be one, that isn't a solution, because the dog that doesn't bark is that unemployment always goes up when they raise the minimum wage, right? Especially minority and teenage unemployment. Those skyrocket when minimum wage is increased. And employers find ways to automate. The McDonald's burger flipping machine, et cetera, et cetera. So you got to really always be attuned to what doesn't happen or what you don't see, right? That's what they don't tell you. Hey, if raising the minimum wage was the answer, then why not just, forget about $15 an hour. Why not make the minimum wage $100,000 an hour? And then everybody will be happy and all problems will be solved, right? Of course, that doesn't work, right? But you can't hear the dogs that don't bark. So the dog not barking in this saying is the shortage is actually more significant than that. And the other dog that's not barking here is price segmentation. So what you see that, this is just overall homes. But the acute shortage that is affecting the market now is entry-level homes, the properties that make good rental properties, the properties that we as investors like to buy for long-term buy and hold rental. And those houses are in particularly short supply. Here's another article, and this is back from 2018. This is from the Joint Center for Housing Studies at Harvard University. Here, the author is saying the number of U.S. households is projected to increase by 12.2 million households in the next decade. So that's from 2018 to 2028, right? And if you think about that and think about the number of homes being built, and here's the other dog that doesn't bark that I didn't mention before, the number of homes that become obsolete, right? After a while, a house just gets too old and decrepit and, it falls apart. So nobody wants that house. Or if you have a tragic natural disaster like we just experienced here in Florida, you have housing stock that is destroyed. So that, again, makes the shortage even worse than the kind of numbers they're talking about here. Okay, so let's look at the current housing inventory. And I just interviewed Mike Simonson again yesterday. He's from Altos Research. I like their statistics because they only look at homes in the MLS. And they look at every home in the country. And every week they come out with a report. And I always talk about it on my podcast and my YouTube channel. And right now, housing inventory is at 561,000 units in the United States. Now, the question is, compared to what, right? What do we need to be in a quote unquote normal market? And I'm not talking about a buyer's market or a bad market or a, serious downturn where there's a crash, right? I'm just talking about a normal market, okay? A normal market. Most experts will tell you that we need about 1 million to 1.5 million homes for sale to be in a normal market. Currently, we have 561,000. Now, was it much lower than that before? Absolutely. It got scary low right at this point, right? Just earlier this year. And then last year, we were only at about 426,000, So that's what you're comparing it to. But when you step back and look at a broader view, a longer view of history, you see that even just back in 2015, which I remember like it was yesterday, okay, we were doing lots of business in 2015. Entry-level homes back then were in short supply. Granted, there was more supply than today, for sure. But those entry-level rental properties, and just so you know my perspective, what my company does, Empowered Investor, is we help investors build nationwide portfolios. They come to us and they buy properties through our network, rental properties to buy and hold. Okay. And so, I remember back in 2015, we were coming out 7 years coming out of the Great Recession, right? And people were saying, wow, the market has appreciated for too long. It's got to end. I'm going to keep my powder dry. I'm going to hoard my cash and keep it in the bank and wait for the correction. And we all know what happened. There was no correction. Prices just kept going up and up. And then, of course, the beginning of the COVID era, everybody said the same thing, right? They said, gosh, there's going to be a huge market crash. I'm going to keep all my cash. I'm going to buy those properties up like crazy. They're going to be way cheaper. And now they have to pay, 40% more in some cases, right? So the game of real estate, as we all know if we're seasoned, is that over time, the prices are going to be higher than they are today. I mean, even if there's a correction in between, Does anybody watching this or listening to this think that in 5 years or 7 years, prices will actually be lower than they are today? Extremely unlikely. Now, there's another thing I want to tell you here, and that's why I put this little green thing. Big idea. New versus resale. Here's the thing. Well, let me get back to that in a moment because I got another chart I got to show you that'll bring that point better than this. This is just, again, talking about how, we're going to add another 100 million people in the United States over the next, 40-ish years or so. And that's going to require a lot more housing stock. But here's the chart I want to show you. I just got a hold of this chart yesterday because I had long been saying, and I knew the statistics, that 25% of the country has a mortgage below 3%. That's incredible, right? But this chart segments it by 3.5%, 4%, 4.5%, 5%, 5.5%, et cetera, right? And this is the overall layout of what rate American homeowners are paying on their mortgage. And there is a huge reason this is important. So let me get to this. Let's just look at the chart for a moment. Okay, so first of all, 65% of all mortgages in the country are below 4%. That is astonishing. Astonishing. Here's what this chart doesn't tell you. What dogs aren't barking here? It doesn't tell you, because it's only talking about homes with mortgages. What it doesn't tell you is that 40% of all homes in the country have no mortgage at all. They're free and clear. They're paid off. Now, why is this so important, these two things? It's because if you want to have a real estate crash, you better have a distressed homeowner that becomes a distressed seller that's willing to take any offer they can get. And you've got to have those people in mass so they are dumping a lot of homes on the market at any one time. There's no sign of that, folks. Not even an inkling of that. Let's take a look. 285,000 people have mortgages below 2%. That's shocking. 2 to 2.5%, 4.7 million people. 2.5 to 3%, over 13 million people. And on it goes, right? Even if prices soften more, and they have softened a little bit since we've seen these rate increases, even if they soften more, guess what happens? There's a concept called absolute value and a concept called relative value. So in absolute value, the home maybe was worth $325,000, and now it's only worth $310,000. So it's gone down by $15,000. That's the absolute value. But the relative value is the value to the person who owns the home and holds the mortgage on that home. Of course, we all know that if you sell the house, you lose the mortgage. You can't take the mortgage with you. It's attached to the house. It's attached to the property. So where would a big motivation be for people to sell their homes and lose these mortgages? One of the things we're seeing right now is a complete lack of resale inventory because so many people are hoarding these cheap mortgages. They don't want to let them go. They want to keep the cheap mortgages. And in terms of relative value, the value of that property is actually higher to the person that owns it than the market value because they can't replace that mortgage. It's completely impossible to replace. And why would they sell their house if they have to trade their 3% or 3.5% mortgage for a 6% mortgage? There's just not going to be a lot of motivation to do that. Even if they run into economic hardship, they will beg, borrow, and steal to try and keep these cheap mortgages. So that's a very important thing to understand, is that you got to have a motivated seller and a distressed homeowner. Uninformed people are trying to make comparisons to 2008, the Great Recession, the worst economy in 7 decades, a lifetime event, right? Since the 1930s, the Great Depression, we had the Great Recession. And there simply is no comparison to what's happening today. And I know the famous last words of any investor is, This time it's different. But it really is different. I mean, it absolutely is different. The data doesn't lie. The banks have been extremely strict underwriting mortgages coming out of the Great Recession. Inventory is very low. It was very high coming into the Great Recession. So it's a completely different set of dynamics. Now, I'm not saying there's not problems. There are big problems. But I just want to point this stuff out, a lot of this stuff that nobody's really talking about. Okay. So the index, the Hartman Comparison Index, this is another way to look at real estate values, okay? And it answers the bubble question. These are a couple other concepts I teach. We don't have time to go into those today. But I want to first start by comparing the housing price to gold. And if you saw this before when I was on with Ron a few months ago, this has all been updated. The update, because things are changing quickly now, is to the end of the third quarter, okay? So here we are at about $390,000. Now, of course, that depends which survey you're using. Okay. We use the NAR survey, and gold is just over $1,700 an ounce. So today, if you stored your wealth in gold rather than dollars, and look, we all have a choice. Whenever we get paid, we can take the money we get paid and we can exchange it for gold or stocks or bonds or any one of a number of commodities or whatever, right? Or we can just store our wealth in dollars in a savings account, which we know will get debased by inflation. So I'll use gold as the first example. I'm definitely not a gold bug, but it is considered money to most people around the world, and it has been considered money for thousands of years. So today, it would take 227 ounces of gold to buy the median price house. Well, how many ounces of gold did it take in 2010 when the median price house was only $171,000? Back then, it took 158 ounces of gold. So it's definitely more expensive today than it was, 2 years into the Great Recession. How about in 2020? That was a super cheap time to buy a house, and 2021 was even cheaper. Well, not in gold, it wasn't, but when you look at the payment on the house, it was cheaper. And we see 164, 199 ounces of gold. But let's go back to, 1990, for example. Back then, it took 228 ounces of gold to buy the median price house, which was only $95,000. In the year 2000, just before 9/11, when the dot-com bubble was blowing up, right? And, the internet age was really getting its foothold, gold was $283 an ounce. House was $147,000, and it took 520 ounces of gold to buy the median price house. So the question is, priced in gold, is housing cheap or expensive? And the answer is, it's not the cheapest it's ever been, and it's not the most expensive it's ever been. It's actually historically kind of reasonable priced in gold. Let's look at something else. Let's look at oil. Oil is one of the most important commodities in the world. It doesn't matter what all the greenies say, the world still runs on oil. So back in 1970, a median price house was $23,000. Oil was $4 a barrel, and it would take 6,400 barrels of oil to buy the median priced house. In 1980, the house price had almost tripled in dollars, and oil had gone up almost 10 times, but it only took 1,700 barrels of oil to buy the house then. Today, it takes, for that $390,000 house and $94 a barrel oil, it takes 4,100 barrels of oil to buy a house. Now, looking back, just in 2021, it was over 5,000 barrels. In 2020, it was 6,600 barrels of oil to buy the median price house. So it is cheaper priced in oil than it was a lot of times recently. Okay. So priced in oil, cheaper, expensive. You already know the answer. Okay. What about rice? Rice is the food stock of 3/4 of the human race. It's the base food, and it's super important. Rice is measured in hundredweight bags, and it was 43,000 units to buy the median price house 52 years ago. Today, it's only about 22,000 units to buy the median price house. So priced in rice, it is dramatically cheaper than it used to be. It's been a little cheaper in 1990, but mostly more expensive. Okay, so another comparison. How about shares of the S&P 500 index, the Standard and Poor's index? You know, this is the most common thing. People will get paid, they'll get their income from their job or their business, and they'll buy stock with it. Okay, well, if you did that and you were saving for a house, in 1970, you would need 249 shares of the S&P 500 index to buy the median price house. In 1980, housing got a lot more expensive. You needed 466 shares. In fact, that's the most expensive it's been priced in shares of the S&P. Today, it's only about 98 shares. So priced in shares of the S&P 500 index, housing is actually quite cheap. It's been a little bit cheaper, but not much. It's pretty darn cheap. Okay. You can price it in median income. It's a little expensive when you look at it in median income. You can price it in copper. You can price it in alcohol. You can price it in haircuts. You can price it in wheat. You can price it in the Russian ruble. And I added this because of the invasion of Ukraine. Things got interesting there. So you've got a lot of choices in terms of what to do here. So the Goldman Sachs Commodity Index would be another measure. I can just go on and on. But here's the deal. It's not really about the price of the house because most people finance a house. They don't pay cash for it. It's about the payment on the house. So this is how I will wrap it up. Let me share with you a couple of really interesting charts. And I have not shared this before for Ron's group. So this is completely new information. So this is from the Fred website. This is very commonly used. It's the St. Louis Federal Reserve. They've got tons of data. It's really a great resource. And I covered this part up because I don't want you to see it yet. We'll get there in a moment, okay? But what this is the mortgage debt service payments as a percentage of disposable income. That's what this chart is showing. So just look with me at this little part over here, okay? This little part, and you'll see that the mortgage debt service was super cheap during the COVID era, right? And when everybody decided COVID was over, it's more expensive than that today. But the question is, compared to what? That was an anomaly. People are trying to make what happened during the COVID era a benchmark. It's not a benchmark. It was an anomaly. It was a completely strange, unusual situation that will probably never be repeated in our lifetimes. I mean, we all have to admit, look, we saw the lowest interest rates. I kid you not. You're not going to believe this, but I'm going to tell you my source. We saw the lowest interest rates in 5,000 years. Yeah. Can't believe anybody measured it back that far. They did. There are historical records of interest rates dating back 5,000 years. Great book recommendation. I never got this guy on my show. He passed away. But the late David Graeber wrote a fantastic book called Debt, the First 5,000 Years. I would highly recommend that to you. Debt, the First 5,000 Years by David Graeber. Really good book. Okay. So now when we back out and look at the bigger picture, let's take a look at how this chart looks. Okay. So let's back out and go to, 2014. And you see that right now it's much cheaper than it's been since 2014, right? So we've got 8 years of history there. But what if we go back even further? Let's go back to 1980, okay? Or the early 80s. I'm not sure exactly what year because it doesn't tell you, okay? But we see that the mortgage debt burden has been dramatically higher than it is today. And guess what? It was the highest it's ever been preceding the Great Recession in 2008. And then we all know what happened after that. And that mortgage debt burden came down, and then it got really, really cheap. And it's gotten a little more expensive than that now. But the important thing to do is to not be so myopic like so many people are. By the way, I just noticed I got to change this because when I remove the cover up, it goes back to the early 80s. But people are so myopic because they're making bad comparisons. They're comparing things to the way they were a year ago or 2 years ago. That is not the right comparison. You have to have a longer view of history to get a proper comparison. And you see that it's actually still pretty cheap, amazingly. Okay, well, let's look at it another way. So here is the mortgage payment for the median price house based on 20% down and the interest rate and the price of the home at that time. In 1970, it was $127 a month. By 1980, it was $520 a month. Houses were super unaffordable after we had the massive inflation in the late 70s during the terrible Carter era. And then we had high interest rates as Paul Volcker was trying to break the back of inflation. So housing became very unaffordable. But by 1990, it was even worse. It was 646. But if you compare it to the inflation rate and you adjust for inflation, here's the inflation adjusted number by the government's measure, the Consumer Price Index, or CPI. Now, the CPI is a scam. I actually like to call it the CP lie, because it is a lie. What they do is they manipulate the Consumer Price Index to fool us all into believing that inflation is lower than it really is. How do they do this, and why do they do it? Well, first, the why. When inflation got really bad in the late 70s, remember it was, Nixon took us off the gold standard in 1971, and inflation started to run rampant because the government just started printing money willy-nilly. Remember, anything in the world can be valued by two things. Okay, these are just my two. Okay, you may disagree. Utility, in other words, how useful is it? And scarcity, how scarce is it? Now, money has a utility, right? Dollars have a utility. We all know that. We can spend them and buy things. That's great. But if they're not scarce, they're going to be less valuable if there's a lot of them. And they keep printing more and more, so they keep getting less valuable. And so what they wanted to do is they wanted to hide the real inflation rate for two big reasons. Number one, they want to keep the electorate, the voters, happy, right? They want to fool them by making them think things are better than they really are, right? But everybody just kind of intuitively knows how expensive things are getting. But number two, government is such a large part of the economy that all of the government benefits, Social Security, every other welfare state benefit, and government payroll, government employees all get COLA adjustments, cost of living adjustments, right? Or cost of living increases. And they do that by measuring it against the CPI. So if the CPI is 9%, they got to raise everything 9%. If it's only 2%, then they only have to raise it 2%. So the government has a huge incentive to hide the real rate of inflation. So the CP lie is misleading. So I'm going to get to a more accurate thing in just a moment. But let's just look at the CP lie for a moment. All right. Oh, by the way, how do they manipulate the Consumer Price Index? We didn't talk about that yet. Three major ways: weighting, substitution, and hedonic indexing. So weighting, the CPI is a basket of goods. So what they'll do is when one thing or a few things in the basket get really expensive, they will give them less weight. So in the formula doing the math, there's not as much weight on those things, which will lessen the rate of inflation. Now, substitution. Okay, here's what they do. If beef is in the index and it gets too expensive, they'll just substitute it for chicken. Okay, they'll just assume everybody will just switch from beef to chicken, but maybe you don't like chicken because chicken's a dirty bird. Okay, you want to eat beef. And so that's how they will hide the real rate of inflation: substitution. The last one, the third one, hedonic indexing, hedonic adjustments. So this iPhone of mine costs $1,500, and there's my cute dog on it. Isn't she cute? So this is a $1,500 phone, right? Now, my first cell phone weighed 14 pounds and it cost $3,200. And I actually financed it when I bought it. And the only thing you could do with it was call people or receive calls. You couldn't even send text messages. On this phone, you can do pretty much everything you'd ever want to do, right? So things keep getting better. That's called progress. That's how it should be, right? But what the Consumer Price Index does through hedonic adjustments is they assume that if you buy a new phone today and you pay $1,500 for the phone and it's twice as good as the last phone, and you also paid $1,500 for that, they'll assume you only paid $750 for the new one because it's twice as good. Hedonic adjustments. And there is some logic to that. I understand that. But the problem is hedonic indexing basically says we as people aren't entitled to progress. The Consumer Price Index gets the benefit of the progress, not us. We should get the benefit of progress, right? Because, hey, That's evolution, right? Everything should keep getting better. That's just the natural progression of things. New ideas, new innovations, capitalism doing its great thing, and it should keep making life better. But the consumer price index gets the benefit. So there's another measure of inflation. There's a great website called shadowstats.com. Go check it out. I interviewed the founder, John Williams, on my podcast. And what he does is he simply calculates inflation the way the government used to calculate inflation before they started really finagling the index in the early 80s. And if you just use the government's old way, not his way, not some special way, the government's way that they would calculate inflation before they started really monkeying with the whole thing in the early 80s, in the late 70s. Okay. Then you see that this mortgage payment changes quite a bit. So we go to 1970, the mortgage payment on the median price house is $127. By 1980, adjusting for the CPI, the consumer price index, it's $253 adjusted for inflation, but in nominal dollars, you're paying $520 a month. But with all the inflation, it only feels like $253. Now, this was before the real changes came to the index. There was a little bit of change. It starts to diverge here, though. It's $241, the old way they used to calculate it. But by 1990, it becomes really significant. It's $646 in nominal dollars. So Americans are writing a check every month to pay their mortgage for $646. And if you compare it to 20 years earlier, it only felt like $192 according to the CPI. But according to the real world, it felt like $137. Does everybody follow that? You really got to follow that. There's a huge difference between what they call nominal dollars and real dollars. Nominal dollars is the name of the dollars. So how much do you write the check for? $646. That's the nominal dollars. Real dollars is how much does it feel like? That's the real amount, right? That's what matters. So let's fast forward to today. Today, the nominal mortgage payment is about $1,800 per month. And I know everybody thinks that's super high. If you adjust it for inflation, it's $238. But if you adjust it for the old way they used to calculate inflation, it's only $70. So adjusting for inflation before the government started to manipulate the consumer price index, is it cheap or is it expensive? It's actually quite cheap. So it's actually a lot cheaper than most people think. Now, why doesn't anybody feel that way? Why does everybody, I can hear all of you right now. You're saying, but Jason, housing is so expensive. Everybody knows that. You're telling us something that's just ridiculous. Well, let's examine that. Let's peel back the layers of that onion. The average house in 1970 was 1,500 square feet. The average house today is 2,300 square feet. It's 157% larger. And it's also better. The house today is dramatically better in terms of quality than a house 52 years ago. Nobody would question that. So when you price it in actual price, and I've got another chart, I just don't have it handy right here, but when you price it per square foot, adjusted for price of the house, interest rates, and inflation, and I do have another chart for that, it's just not in this deck, it's incredibly cheap. Housing is much cheaper. So why don't we feel that it's cheap? Well, because number one, we have a short comparison time frame, and number two, just like I told you about the consumer price index and how they do what's called hedonic adjustments, right? That word hedonic, the root of it is hedonism. Hedonism means pleasure seeking, right? So how much pleasure do we get out of the cell phone, the new one versus the old one? That's the hedonic adjustment. But guess where else hedonic adjustments happen? They happen in our brain. We become used to things, and psychologists call this hedonic adaptation. And, as people, we expect a lot. We're actually pretty spoiled, okay? And we just keep expecting more. And that's why the housing doesn't feel that cheap, because we're not really comparing it objectively to what it was like 52 years ago. Okay. And what I say on my podcast all the time and on my YouTube channel, I always say people must have a good sense of history. And in order to do this, it's really quite easy. Watch old TV shows, watch old movies, listen to old music, and read old books. And when I say old, it doesn't even have to be that old. Watch something from the 90s, watch something from the 80s and the 70s and the 60s, right? And you can just see how different life was back then. You if you watch a contemporary show where it's like a reality show, like I don't watch reality shows, but take like Real Housewives or one of those stupid shows. I hate reality TV. It's so boring, but I know people love it, so I'm probably in the minority. Anyway, take one of those Real Housewives shows, right? And you walk into someone's house and, they've got like everything. They've got all the latest gadgets, big screen TVs, granite countertops or quartz countertops and super high end finishes, right? Go watch an old TV show like the show Columbo, the detective, the really smart detective who always caught the criminal. And Columbo did a lot of his investigations in high end homes, expensive upscale homes. And the camera's in there and it's depicting a scene of life in the 70s. And, it's just not nearly as good as it is today. We've all had hedonic adaptation. And that's why we think it's more expensive than it really was. Okay. If we went and we got a 1970s home that wasn't remodeled, we could get that house awfully cheap. Okay. And adjust that for inflation and for size and for everything. You'd see it's really quite a bit cheaper than you think. Okay. So I just wanted to bring that up. Now, does house price even matter that much? This is a good question. And I'll just conclude and wrap it up with this. I created this chart to show what I call the mortgage rate sensitivity. What does that mean? Well, it shows you the number of people who can afford a median price home at different mortgage interest rates. And this is very enlightening, folks. Because remember, there's a whole flip side to this discussion. I mean, I don't much care if prices go up or down, right? I mean, I'd rather have them go up because I own, a decent amount of real estate. But if they go down, it's not that big a deal because I'm a yield-oriented investor. I invest for income, for yield, for return on investment. And if I'm not selling the property, the value going up doesn't much matter to me. It doesn't really change anything much. Okay. At 3.11%, which was the mortgage rate on January 31st of this year, 52 million people could afford the median priced house, and 76 million could not afford the median priced house. Okay. Now you see the median price went up a bit, but the interest rates almost doubled by the end of June of this year, meaning that knocked a whole bunch of people out of the market. Only 38 million could now afford the median price house, and 92 million could not afford the median price house. If we're at 415,000 and 7% interest, which arguably we might be there depending on the borrower and the mortgage program, only 34 million people can afford the house and 95 million cannot afford the house. And it goes on as rates get higher. Why does this matter? It matters because if you are a rental property investor, then what you want is to see housing affordability be lower. Because when it's lower, more people stay in the renter pool and it puts upward pressure on rents. These two are non-correlating indicators, okay? So when housing affordability is high, people move out of your rentals and they buy a house and you lose your tenants because they become buyers, they become homeowners. When housing affordability is low, they stay in the rental pool, and that puts upward pressure on rents. And this cycle constantly repeats. The thing you have to understand is that rents always lag prices by a good 2 years, maybe really 3 years or more. It depends where, and this stuff is lumpy. It's not that exact of a science, right? But I believe, rents are kind of leveling off a bit. They've gone up so high already. But I believe that we have a lot of rent increases in the future, especially as housing affordability gets lower and lower.